There is a waterway on the other side of the world that is 33 kilometers wide at its narrowest point. 33 kilometers. You could drive across it in 20 minutes. And right now, in 2026, that waterway, the Strait of Hormuz, is the single most important choke point in the entire global economy. 20% of the world's oil supply moves through it every single day. And the military, political, and economic tensions surrounding it are at levels that energy analysts, Pentagon planners, and financial risk managers are privately describing as the most dangerous they have been in 40 years. If that strait closes, even for 30 days, what happens to your gas tank, your grocery bill, your mortgage, your investments, and your job is not abstract. It is direct. It is fast. And most people have absolutely no idea it is coming. In the next 10 minutes, I'm going to show you exactly what the Strait of Hormuz is, why 2026 is a uniquely dangerous moment, what history tells us about what happens when it gets disrupted, how the consequences cascade directly into your financial life, and precisely what you need to do with your money right now to prepare. Let me start with the geography, because you cannot understand the economic stakes without understanding what this waterway actually is and why it is so irreplaceable. The Strait of Hormuz is a narrow passage connecting the Persian Gulf to the Gulf of Oman, and from there to the Arabian Sea and the broader global ocean trade network. On one side sits Iran, on the other side sit the United Arab Emirates and Oman. The strait is approximately 167 kilometers long, but narrows at its most critical point to just 33 kilometers wide, and the navigable shipping lanes within that width are only about 3 kilometers in each direction, with a separation zone between them. Through those 6 kilometers of navigable water, 3 kilometers going in, 3 kilometers going out, flows approximately 20 to 21 million barrels of crude oil and petroleum products every single day. That is roughly 1/5 of the world's daily oil consumption. It is the single largest choke point for oil in the entire global trading system, and there is no meaningful alternative route. Think about what that means in practical terms. If you live in Japan, you import nearly 100% of your oil, and approximately 90% of it passes through the Strait of Hormuz. South Korea? Similar dependency. India? Approximately 65% of its oil imports pass through the strait. Even Europe, which has more diversified supply, would see significant disruption. The countries most dependent on Hormuz passage are collectively responsible for enormous chunks of global manufacturing, global technology production, and global trade. When their oil supply gets disrupted, their economies get disrupted. And when their economies get disrupted, the global economy, including the United States, does not escape. But wait, you might be thinking, the United States is the world's largest oil producer. It pumps approximately 13 million barrels per day as of 2026. How badly could a Hormuz disruption actually hit America? This is the most common misconception about this risk, and I want to address it directly, because the answer is more than most Americans think, and the mechanism is not what most people expect. Here's the reality. The United States still imports approximately 6 to 8 million barrels of oil per day, even at its current record production levels. Some of that comes from Canada, some from Mexico, some from other Western Hemisphere sources, but some still flows from Gulf producers. More importantly, oil is a globally priced commodity. When the Strait of Hormuz is disrupted, oil prices do not go up only for the countries that import from the Gulf. They go up for everyone, everywhere, simultaneously, because oil trades on a global market with a single global price benchmark. American refiners, American airlines, American trucking companies, American manufacturers all pay the global price for oil. And when that global price spikes because Hormuz is disrupted, every American who drives a car, buys groceries, flies anywhere, or uses any product that was manufactured or transported, which is every American, feels it. And there is a second mechanism that is even less understood. The Strait of Hormuz is not just an oil choke point. Approximately $3.5 trillion of trade passes through it annually, including liquefied natural gas, petrochemicals, and manufactured goods from Gulf nations. Qatar, which supplies approximately 20 to 25% of global LNG, ships all of its LNG through the strait. A disruption does not just spike oil prices, it disrupts the natural gas supply that powers European industry, Asian manufacturing, and increasingly US LNG export customers. The economic tentacles of the Strait of Hormuz extend far beyond crude oil. Now let me tell you exactly why 2026 is a moment of particular danger and why this is not just a chronic background risk that has always been there. The Strait of Hormuz has always been a geopolitical flashpoint, but in 2026, the combination of factors creating pressure on that waterway is more dangerous than at any point since the Iran-Iraq War of the 1980s. And I want to be specific about why, because understanding the specific pressure points is essential for understanding the probability and the severity of a disruption. The first factor is the state of the Iran nuclear situation. The nuclear deal, the Joint Comprehensive Plan of Action, effectively collapsed during the Trump administration's first term and was never fully restored. As of 2026, Iran's uranium enrichment program has significantly progressed. Multiple credible intelligence assessments suggest Iran is closer to nuclear weapon capability than at any point in its history. The pressure from the United States and Israel to prevent Iran from crossing the nuclear threshold creates a genuine possibility of a military strike on Iranian nuclear facilities, and Iran has explicitly and repeatedly stated that any military strike on its territory would result in the closure of the Strait of Hormuz as a retaliatory measure. The second factor is the pattern of Iranian proxy activity and direct maritime aggression that has been escalating since 2019. In 2019, Iran seized a British-flagged tanker in the strait. Multiple oil tankers were attacked in the Gulf of Oman in 2019 using limpet mines that U.S. intelligence attributed to Iran. In 2023 and 2024, Iranian-backed Houthi forces in Yemen began attacking commercial shipping in the Red Sea, directly adjacent to another critical oil transit choke point, the Bab el-Mandeb, demonstrating Iran's willingness and capability to use proxies for maritime economic warfare. In 2025, maritime insurance rates for vessels transiting the Persian Gulf region reached their highest levels in decades. The market is already pricing in elevated risk. The physical threat is already partially present. The third factor is the broader Middle East conflict environment in 2026. The Gaza conflict that began in October 2023 has evolved into a broader regional tension involving Lebanon, Syria, Yemen, and Iran directly. The risk of miscalculation of an event that was not intended to be a full escalation becoming one is substantially elevated when military forces from multiple nations with conflicting interests are operating in close proximity across a wide regional theater. Geopolitical risks are not always the result of deliberate decisions. Sometimes they are the result of accidents that nobody intended, but that neither side can back down from. And the fourth factor, and this one is specifically financial, is the state of the U.S. Strategic Petroleum Reserve. As I mentioned in a previous video, the SPR was dramatically drawn down between 2021 and 2023 and has only been partially refilled as of 2026. In a Hormuz disruption scenario, the U.S. government's primary tool for buffering the domestic impact, releasing SPR reserves to calm oil markets, is significantly less powerful than it was during previous crises. The ammunition is reduced. The shock absorber is thinner.
Now let me show you what all of these pressure points look like in practice. Let me walk you through what a serious Strait of Hormuz disruption, not a full closure, but a serious disruption, actually looks like for the U.S. economy and for your personal finances. The critical distinction here is between a partial disruption and a full closure. A full closure of the strait, Iran completely stopping all tanker traffic, is the extreme scenario. Naval analysts consider it unlikely to be sustained for more than a few weeks because the military response would be overwhelming. But a partial disruption, harassment of tankers, mining of shipping lanes, seizure of individual vessels, insurance markets effectively shutting down transit, does not need to be a full closure to be economically devastating. The 2019 tanker attacks alone, without any actual supply reduction of the strait, created significant oil price volatility and insurance market disruption. A sustained partial disruption in 2026 could achieve the same economic impact as a temporary full closure. Let me take you back through history, because the Strait of Hormuz has been at the center of geopolitical crises before, and the historical record tells us exactly what to expect. The most directly relevant historical parallel is the tanker war of the 1980s. During the Iran-Iraq War, both nations attacked oil tankers transiting the Persian Gulf in what became known as the Tanker War, roughly from 1984 to 1988. Over 500 ships were attacked. Oil prices were volatile and elevated throughout. The United States eventually responded by reflagging Kuwaiti oil tankers under the American flag and providing naval escorts, Operation Earnest Will. The disruption was significant, prolonged, and economically costly, but the strait was never fully closed because neither side was willing to accept the military consequences of a full closure that would have brought the full weight of U.S. naval power to bear. The 1990 Gulf War provides another critical data point. When Saddam Hussein invaded Kuwait in August 1990, oil prices spiked approximately 70% within weeks, from roughly $17 per barrel to nearly $30 per barrel, on fear of supply disruption, not actual supply disruption. The actual disruption to supply from Kuwait and Iraq was real, but the fear premium moved prices faster and further than the physical shortage alone would have justified. The United States economy entered recession in 1990 and 1991, and economists have attributed a meaningful portion of that recession to the oil price spike and the consumer confidence destruction that accompanied the uncertainty of the Gulf War period. Now here is what makes the 2026 context categorically different from those historical episodes. In both the 1980s Tanker War and the 1990 Gulf War, the United States' relationship with Gulf oil producers was straightforwardly protective. The U.S. had a clear interest in keeping oil flowing, a clear military capability to protect that flow, and a clear alliance structure with Saudi Arabia, Kuwait, and the UAE that made U.S. military intervention politically straightforward. In 2026, that alliance structure is more complicated. The Abraham Accords have created new diplomatic relations in the region, but the broader U.S.-Middle East relationship has been strained by the Gaza conflict, by questions about U.S. commitment to regional security, and by the Gulf states' growing economic relationships with China, which now imports more Middle Eastern oil than any other nation. Saudi Arabia and China completed their first yuan-denominated oil transactions in 2023. The Gulf states are hedging their geopolitical bets in ways they never did during the Cold War era. The U.S. military capability remains formidable, but the political and diplomatic context for exercising it is more complex than it has ever been. And there is one more crucial 2026 specific factor. The United States military is simultaneously managing strategic competition with China in the Pacific, ongoing support for Ukraine and Eastern Europe, and force posture considerations across the Middle East. The question of whether the U.S. has the military bandwidth, the domestic political support, and the international coalition to mount a robust response to a Hormuz disruption while simultaneously managing these other strategic commitments is not a question with a simple answer. It is a question that adversaries, including Iran, are actively modeling. So, what does this all add up to for your finances? Let me get specific. Let me be completely direct about the personal financial consequences, because I think most people dramatically underestimate how fast and how deeply a Hormuz crisis reaches into everyday American life. The first and most immediate impact is at the gas pump. A serious Hormuz disruption, not a full closure, but a significant partial disruption sustained for 30 to 60 days, would likely push crude oil prices from current levels in the $80 to $90 range to $120, $140, possibly $160 per barrel within days to weeks. The 2019 tanker attacks alone, without any actual supply reduction, pushed oil prices by 10 to 15% in hours. A sustained 2026 disruption would be a much more significant event. At $140 oil, U.S. retail gasoline prices move from approximately $3.50 per gallon to somewhere between $5.50 and $7 per gallon, depending on regional refining capacity and state tax structures. For the average American household, that means an additional $1,500 to $2,000 per year in fuel costs, arriving almost overnight. Airlines get hit simultaneously and severely. Jet fuel is already the single largest operating cost for most airlines. At $140 to $160 crude, jet fuel costs roughly double. Airlines cannot absorb that. They will pass it through in the form of fuel surcharges, higher base fares, and in some cases, route cancellations. Business travel becomes dramatically more expensive. Family vacations get repriced or canceled. And the airline industry, which is already navigating significant financial complexity in 2026, faces genuine viability questions at the smaller carrier level. Food prices. This one takes slightly longer to show up because supply chains have some buffer, but within 30 to 60 days of a sustained oil price spike at this level, grocery prices begin moving upward. Diesel for trucks, fertilizer, which is a natural gas and petroleum derivative for crops, packaging, which is petroleum-based plastic, all of it gets repriced simultaneously. Agricultural economists estimate that a sustained move to $140 oil could add 10 to 20% to food prices within 6 months. On a grocery budget that is already elevated from the 2021 to 2023 inflation surge, that's a significant and painful additional burden. Now let me talk about the investment portfolio dimension, because the Hormuz disruption scenario is not uniformly negative for investors, and understanding where the winners and losers sit is essential for making good decisions. The clear winners in a Hormuz disruption are energy sector stocks. Integrated oil majors, ExxonMobil, Shell, BP, see their revenues and profits surge when oil prices spike. In 2022, the S&P 500 energy sector gained over 60% in a year when the broader market fell 20%. In a Hormuz disruption that pushes oil to $140 or $160 per barrel, energy sector outperformance could be even more dramatic. If you are not currently holding any energy sector exposure, this is a meaningful gap in your inflation and geopolitical risk hedging. Gold is the second major beneficiary. Geopolitical crises of this magnitude, a potential military confrontation in the world's most oil-critical waterway, drives significant safe haven demand for gold. Gold is already trading above $3,000 an ounce in 2026, reflecting existing geopolitical anxiety. In a genuine Hormuz crisis, gold could move substantially higher as investors globally seek protection from currency debasement, inflation, and financial system stress simultaneously. Defense sector stocks are a more uncomfortable but financially relevant consideration. Lockheed Martin, Raytheon, General Dynamics, Northrop Grumman, defense contractors whose revenues depend on U.S. defense spending historically perform well during periods of elevated geopolitical tension and actual military operations. If a Hormuz crisis results in significant U.S. military engagement, defense spending increases are virtually certain. The clear losers are airline stocks, consumer discretionary stocks, retail, restaurants, entertainment, and any company with significant transportation costs embedded in their business model. Emerging market equities from oil importing nations, Japan, South Korea, India, Taiwan, also face significant headwinds in a sustained oil price spike because those nations' economies are most directly impacted by Hormuz disruption. And bonds. A Hormuz disruption that triggers a significant oil price spike and inflation resurgence puts the Federal Reserve in a very difficult position. If the Fed raises rates to contain the inflationary impact of the oil shock, as it arguably should from an inflation-fighting credibility standpoint, it risks pushing an already complex economic environment into recession. If it holds rates steady to protect economic growth, it accepts a higher inflation path. Neither option is good for long-duration bonds. Tips: Treasury inflation-protected securities perform better than nominal bonds in this scenario because their principal adjusts upward with inflation.
Now, and I cannot stress this strongly enough, I am not a licensed financial advisor, and nothing here is personalized financial advice. Talk to a qualified professional about your specific situation, but the framework I have just given you, energy stocks, gold, defense exposure, tips, reduction of airline and consumer discretionary overweight, is the framework that sophisticated institutional investors use to position for elevated geopolitical risk in oil markets. Let me give you the honest big picture assessment that I think you need to hear. The Strait of Hormuz crisis is not a bolt from the blue risk. It is a chronic, structural vulnerability in the global economy that has existed for decades, and that 2026 geopolitical conditions are making more acute than at any point in recent memory. The combination of Iranian nuclear progress, elevated regional military activity, a more complicated U.S. alliance structure in the Gulf, a thinner U.S. strategic petroleum reserve, and an already elevated inflationary baseline in the United States creates a risk environment that is genuinely more dangerous than most mainstream financial commentary acknowledges. The honest assessment is this: a significant Hormuz disruption, not a full closure but a sustained partial disruption, is not a tail risk. It is a scenario that competent risk managers at major financial institutions are treating as a meaningful probability event for 2026 and 2027. The probability is not 50%, but it is also not the kind of 1 in 100 risk that can be safely ignored in portfolio construction. And here is the asymmetry that matters for your decision-making. The cost of modest preparation for this scenario, holding some energy sector exposure, some gold, understanding your inflation vulnerability, maintaining liquidity, is low. If the disruption does not happen, these positions contribute to a portfolio that is reasonably diversified across geopolitical scenarios. If the disruption does happen, those positions could mean the difference between your portfolio weathering the crisis and your portfolio being significantly impaired by it. The 1990 Gulf War oil shock hit a U.S. economy that was not fully prepared and contributed to a recession. The 1973 embargo hit an economy that was not prepared and produced a decade of economic pain. In 2026, you have the advantage that none of the investors who lived through those crises had. You have the information before it happens, not after. Use it. Audit your energy exposure. Add your inflation and geopolitical risk hedges. Understand your vulnerability to oil price spikes in your personal budget, and stay informed about the signals that tell you when this risk is escalating. Drop a comment below. Do you think a Strait of Hormuz crisis in 2026 is likely, or are you not worried about it? And if you made any portfolio adjustments based on Middle East geopolitical risk, I genuinely want to know your thinking on this. If this video changed how you assess your geopolitical and energy risk, hit that like button. It takes 1 second, and it genuinely helps this reach more investors who need to think through this scenario. Subscribe if you want the kind of macro risk intelligence that institutions pay for, and that this channel delivers in plain language. Turn on notifications. Share this with one investor in your life who has never considered Hormuz risk as a portfolio factor. Coming up very soon, we are breaking down exactly what the Federal Reserve does when an oil price shock hits, and why its tools in 2026 are more limited than in previous crises. That one is going to fundamentally change how you think about central bank power in your portfolio. I'll see you there.
Subscribe to Investify. More financial videos, real insights, zero fluff. Let's build wealth together.